United States, just like Europe now, is becoming a nation of renters. Ken McElroy is contrarian. So he watches the single family home market and he sees fewer and fewer people being able to get into single family homes. And he even said it right on the podcast. He doesn't agree with this because he thinks housing should be affordable. He's got like kids who are in their 20s who are not going to be able to afford to buy a house. So he watches the single family house. Here's why it's so smart, because everything on the other side of that scale are renters. So if entry level into single family homes is going down, then the margin of renters and potential clients to rent your properties is growing in this country. Hey, what's up all of my real estate peeps, real estate rock stars, entrepreneurs, real estate investors, the whole gamut of people coming here onto the show. My name is Brian Lucier of the Why Not Real Estate Podcast, Golden Nugget, and here we are with another Golden Nugget. Today, we're going to be talking about market shift uncertainty. I've been an investor since 2001, actually 10 days before the towers fell on 9/11, I bought my first property. And on that 12th day, on September 12th, I thought, what have I done? I never should have invested in real estate. And I thought the world was going to fall apart, just like a lot of other people thought the world was going to fall apart. But the world didn't fall apart. And within a couple of days, a couple of weeks, the market had pretty much stabled back out again. Rents still came. The sun shined, it rained. Life went back to normal. But that was the beginning of my first market cycle. And that time in 2001 was a wonderful time for me to buy property. I was buying property at like $70,000 a door. So I was buying, I think my very first property I paid $145,000 for. Unheard of. In today's market, you're paying $200 a door. So that same property I paid $145,000 for in 2001, today's prices would be $550,000 to $600,000. So that's kind of where we are in the third cycle in my experience as a real estate investor. So where are we now and what's going on? Those first two cycles were great for me because I was able to purchase, cash out, refi. This was before bigger pockets. Nobody had heard of the Burr method. I was calling it milk money. And I talked to my dad about this. He says, yeah, that sounds reasonable. So I would buy a property, fatten up that cow, get the rents up, get the equity up, refinance the property, take that milk, bring it to the market and trade the milk for another cow, rinse and repeat, rinse and repeat, rinse and repeat. And I did that off of my first property. And my first property, I recash financed out twice. This property that I paid $145,000 for, refinanced out $90,000, bought two more properties. Market was still going up, so I took those two properties, did that again. So within a 3-year period, my first $40,000 investment was over $1.2 million. And I tell all of that to you to explain where I came from and where we are now. And then in 2008, that was a millionaire maker market, and that's what David Lindahl called it when we were studying with him. He says, buy as much property as you can. When people are afraid to buy real estate, buy as much as you can. And that's exactly what we did. And at that time, I think I said on another podcast, I had bought a 4-unit property for $42,500. Yeah, like $10,000 a door, which you can't even buy a truck for $42,000. Anyways, that was my second time around in that market cycle. And 2008 was interesting because when it crashed, you had so many developers and builders out there in the market who were developing these complexes, and they had permits pulled and everything. And then when the banking bottomed out, and all these bad loans, people who were getting loans who never should have qualified, and the banking system just, the bottom fell out. All these builders got burned, and got burned hard, heavy, and for a long time. And they shied away. And that changed all the dynamics coming into the third market cycle we're in now. Because inventory has been that one linchpin in this whole cycle that's been keeping it from growing and getting bigger. Now, in the last couple of years, some of the hotter markets on the Sun Belt and all that, permits have been coming up. So we're slowly starting to see inventory to get to where it's supposed to be. But now we've got other factors that have happened. I mean, when I started, it was 9/11. That was an unforeseen event that rippled out through all kinds of different markets. Now, today, 2025, we have tariffs, which I just was reading this morning. The cost of steel and aluminum is going up 6%, which is going to affect all these projects that are already started. So who knows what's going to happen? I don't have a crystal ball. I don't know all that stuff. I'm not a guru, but they say real estate is local. All real estate is local, so know your local market. What I do see happening is it's harder to build. And now it's even going to be harder to build. It got crazy to build after 2008 and the last two presidencies when energy code went through the roof, and these airtight homes, energy tight homes, getting away from fossil fuels. I just saw a podcast yesterday. One of my buddies is building this huge multi-million-dollar property, all electric. He's running in a 200 line, I think a 220 line voltage underground going into the property, because all the functioning operating systems are going to be electrical, because building code now has you getting away from fossil fuels. There's an incentive to totally build without fossil fuels. Again, no crystal ball here. I don't know how that's all going to play out, but I do see things are difficult to build. To now, things are just going to be more expensive to afford the materials and supplies that you need. So it's going to make building cost prohibitive. Energy code has already made building cost prohibitive. I hold my construction supervisor license, Massachusetts CSL, so I can go out and pull permits for my clients. I can do a renovation job. Everything's legal. We'll have licensed insured contractors come in and do the work. That's all fine. But to start from scratch, it's just so much more difficult today than it was 10, 15 years ago. And now, with tariffs, lumber, aluminum, the basic raw materials that we need to build are going to cost more money. So it's going to be harder to make that type of inventory that will balance out the market. People are starting to catch on. So here's what's happening. I'm just finally starting to see this happen. I've been watching the market 5, 6, 7 years on the sidelines waiting to get back in. We've interviewed some really, really smart people on the show, Maureen Miles, some other people, Brian Burke. They are now starting to look again at buying deals. Inventory. What's creating the inventory? Costs have gone up, interest rates have gone up. So if you've got these investors who've put money into a deal at an adjustable mortgage rate or something like that, they're getting trapped right now in their margins, and their properties are going to get gobbled up by other people who can come in and maybe put more money down or buy out the loan, buy out the mortgage and assume that mortgage if the banks will allow that, and take over the properties. We're starting to see the opportunities happen again. And it's not because more inventory is being added, it's because more inventory is becoming available. If that means because someone did get into a bad mortgage and now they're going to lose that property, that's somebody else's opportunity. I was watching Robert Kiyosaki on a podcast the other day, and he said disasters, not disasters, but bad news, bad things happening are an opportunity. So now tariffs, bad happening. Inventory, bad happening. Interest rates gone up, bad happening. So there's opportunities there. And we've got a tax code that's going to be unpacked in the next couple months. And none of us as investors really know what's going to happen there. We do know opportunity zones are opening up. Like in the past 5 years, opportunity zones have been a big thing in the local municipalities. They're trying to build up neighborhoods. So if you're going to go in and follow the rules for what they want in their community, you can get a discount, buy this stuff. They'll get you through the permitting process. So you can add housing because inventory has been a real big problem. I think it was 5 years ago, we were some 5 million dwelling units short in the United States. And now that's maybe around 4 million. So we're still way off, but some of the building has happened and now we have an event. Things are more expensive, energy code, it's just cost prohibitive right now. Here we are. It's the beginning, from what I see, of my third market cycle. So here's where I see the opportunities. People get it. They know that interest rates have gone up. They know that they're probably not going to go down very soon. They probably will go down with all the taxes and everything that's going on, but I'm not a psychic here. I don't have a crystal ball. I can't tell you where the market's going to go, but I've seen a few cycles. And you see it all the time, right? Investors come up and say, oh, well, it's going to be different this time. And we know that this is going to happen and that's going to happen. It's going to be totally different. Well, I got a news flash for you. It is never totally different. The market cycles always follow the market cycles. The variables in those cycles may be a little different, maybe some things to tweak, like energy code, now materials, being able to get materials. We went through materials in COVID. You couldn't get materials, and then the prices went through the roof. So that's one of those unknown life world events which will have a ripple out into the different markets. Here we are. I'm starting to see more properties come onto the market. Actually, in the last 6 months, I've been approached by quite a few of our clients who are selling their properties. Like, well, I might be interested in buying your property. Obviously, I already manage it. I know everything about the property. I can go in turnkey and make it happen, but the numbers weren't there for me yet. So here's the phenomenon, right? One lemming follows one lemming follows one lemming. And if one lemming runs off the end of a cliff, well, the next lemming is going to say, well, he ran off the edge of the cliff, so I'm going to follow him. And then the third guy in the line says, well, those two guys ran off the cliff. That's the thing to do. I'll follow them. So how does this all translate into a real estate market? We're starting to see inventory. Prices haven't come down yet. Rents haven't come down yet, but they're definitely not growing at the speed or trajectory they were over the past 5 years. So we're starting to slowly see that shift. And that's what I love about real estate. It's like watching a train on a railroad track. Slow moving, you can see it coming, you can see it come around the bend. You know where it's going to go because it has to stay on track with all those market cycles. So back to the one lemming theory. And this is what I'm seeing with our investors right now. Someone will put their property on the market. They'll take a 3-unit, we'll say a 4-unit, and put it out on the market for $600,000. So the next guy next to him with his 4 units says, wow. They look it up on the MLS or whatever and say, wow, he's making a killing. He's going to make $200,000 if he sells right now. Well, there's only so many buyers. So if I want to cash in on this, I better put my property on the market. So I'm going to take my 4-unit. He went 600, so I'm going to put mine on at 575. And I'll attract that buyer, and I'll make 175 because I paid 400 for mine. And then the next guy sees it and says, wow, there's John and Larry. John, he's going to make 200 off his. He's going to make 175 off his. maybe there won't be enough buyers left for me and my property, and I don't want to hold this for the next cycle, for the next 10, 15 years. I think I better sell now. But if I want to take advantage of the buyer, I better come down a little bit lower. So now I'm going to put mine out there for 580. So you see what happens. The more, and my dad was guilty of this when he had apartments too. When people were buying, he would buy and usually pay too much. And where people were selling, he would sell at a discount price and not make enough. So hear this, my peeps, be contrarian. Warren Buffett says all the time, when people are greedy, get scared, and when people are scared, get greedy. If we see more and more properties come out onto the market, we're going to see not prices go up, we may see them stabilize and eventually turn to go down. Now, there's a hush in the room. If prices go down, what happens? Well, there may be more buyers, so that's going to turn it into a buyer's market because prices are now going down. And people, I mentioned this a while ago, but the interest rates, historically for the last 50 years, have been at 7.8. So right now, I'm going to be getting a commercial mortgage at 6.75. I don't care. I work the numbers into the deal. It's going to be fine. But your mom and pops who've been holding these properties for a long time, or maybe somebody who had an adjustable rate that it's gone up beyond what their margins were going to be profitable, they got to bail. So now inventory is going to come out. And I'm not saying there's going to be a fire sale because it is a slow moving train. You're seeing this now. Watch the market, watch days on market, watch volume of inventory on market, and have your buy box down. Know what type of property you want to buy, where you want to buy it, what your parameters are. Know all that stuff and shop within your range. But I'm seeing it, and yeah, I've walked by maybe 3 or 4 deals already because I didn't think the market or the numbers were there yet. But I just got an off-market deal, which happens sometimes. But right now, the comps I'm seeing are 200. And just to verify this, it's June 9th, 2025. So if you're seeing this years from now, June 9th, 2025, in the Massachusetts market, central New England, around 200K to 230,000 a door. So your 3-unit property probably running around 600,000. I've seen some out there. We just had a 2-family unit, one of our clients sell for over 700,000, which I thought was crazy, over 300 a unit. So yeah, that's out there. So historically, if that's where we are now, this deal that came to me, I ran the numbers and I'm at 130 a door for a 7-unit. I'm doing this deal. I'm going to do this deal. And on the previous podcast, the Yellow podcast, I mentioned about the 30-70 or 40-60, or Ken McElroy doing 50-50 down payment to mortgage. And yeah, I'm going to do this deal and I'm going to do this market. So where are we now? We are in a shift of uncertainty in the market. We're not really sure where things are going to go, but we're seeing it move. It's starting to shift slowly. So if you can see it going to the left, there's the trend. If you can see it going to the right, there's the trend. Okay, for a long time, it's kind of been wavering in the middle because inventory has not allowed the market to shift because we've been stuck at that rate. So there's one more thing I want to mention here before we wrap up. Ken McElroy mentioned this on one of the last podcasts I saw. The United States, just like Europe now, is becoming a nation of renters. Ken McElroy is contrarian. So he watches the single family home market and he sees fewer and fewer people being able to get into single family homes. And he even said it right on the podcast. He doesn't agree with this because he thinks housing should be affordable. He's got like kids who are in their 20s who are not going to be able to afford to buy a house. So he watches the single family house. Here's why it's so smart, because everything on the other side of that scale are renters. So if entry level into single family homes is going down, then the margin of renters and potential clients to rent your properties is growing in this country. And that's where I see it going, because we don't have affordable housing for single family homes. It's harder to build the single family homes. Single family homes now are getting smaller, so you're not going to be able to put as many people in there. Even though they're getting smaller, they're costing the same per square foot to build because of the costs going up and because of energy code regulations. So where do I see it? I see it is the beginning of my third market cycle. And I'm on the sidelines right now. This is the first property I'm purchasing in maybe 7 or 8 years. But the numbers look good on this. At the closing table, I mean, I'm buying it for $900. My comps, I'm pushing this to 1.3, 1.4. And yeah, this sounds wonderful, but you know, again, this isn't a deal that I just woke up this morning and picked off of a cherry tree. I've been watching this cycle for years, waiting for the correct combination of events, and I'm finally starting to see it. Now, I'm coming in at 6.75, which is commercial, so what? That's my world, that's where I live when I do a mortgage. But you know, other people getting into the game, if you're going to do an owner-occupied or something like that, you might be able to come in for 3% or whatever. And you can watch some of the other shows on what I think about that. But yeah, this is the beginning of what I see of a shift in the market. For the last couple of years, I've been putting it out there that this is where I think we are, this is where I think we are. And it hasn't been changing, but now over the past 4 to 6 months, I've been starting to see the train go around the bend. So if this gets more difficult for people to buy, and if interest rates are too high, and less people can buy real estate, then that's the time to buy real estate. And for me, for my dollar, for my coin, rental properties. Love rental properties. The bigger the better for what I can afford. I'm not Ken McElroy. I'm not buying $200, $300 million complexes, but I'm getting properties that will give me sufficient cash flow with margins that even if the market does take a bump, I'm going to be okay. So that's where I am. That's my 20 minutes of where I think the market is today and where I think it's going to go, and the opportunity that you can take advantage of. And I hope that helps. So ladies and gentlemen, all my real estate peeps, rock stars, and entrepreneurs, this is Brian Lucier with the Why Not Real Estate Podcast Golden Nugget, signing off, and we'll see you on the next one.